Right now, a lot of investors are keeping 90 to 100% of their money completely tied up in the market. The logic is simple. We're in the middle of a melt-up, and nobody wants their cash eaten by inflation. But the Strait of Hormuz is a massive geopolitical vulnerability. If tensions there escalate and the flow of energy is disrupted, we could see oil prices spike to $150, $180, or even $200 a barrel. That kind of energy shock historically triggers an immediate recession. Without intervention, that economic pressure would likely cause the stock market to enter a severe crash. A standard, fully invested portfolio is effectively blind to a violent external shockwave of this magnitude, leaving an investor with no room to absorb the impact. Modern governments face immense pressure during downturns. They generally cannot afford the political or economic fallout of a prolonged recession. Because of this, the Federal Reserve is incentivized to act almost immediately at the first sign of a crash. When that volume of stimulus enters the system, it creates a massive surge in liquidity. This flood of cash halts the slide and aggressively reverses it, forming a sharp V-shaped rebound on the chart. If we accept that a sharp drop followed by a rapid government-led recovery is a likely outcome, the question becomes how to position your capital to take advantage of that swing. Choosing to just ride out a crash ignores the established pattern of institutional crisis management and the opportunity it creates. The first option is to do nothing. You keep your money parked in core long-term assets, things like the S&P 500, copper, and gold. If you're a passive investor with a long horizon, this path is acceptable. However, it means you take the full hit of the volatility without any way to capitalize on it. The second option is to try and time the market, selling everything now in the hopes of buying it all back when the crash hits its absolute bottom. Timing a perfect market bottom requires almost impossible precision. It is effectively a gamble disguised as a financial strategy. Passive holding guarantees you absorb the damage, while guessing at bottoms introduces unnecessary risk. Neither approach actively manages the actual threat. That leads us to the third path, staying invested, but building a protective, counterweighted shield around your core positions. Part one of this shield is a heavy position in oil assets. Since an oil spike is the likely trigger for the crash, this holding acts as a direct counterweight to your stocks. Part two is stockpiling cash. By selling non-essential positions, halting dividend reinvestment, and selling covered calls, you begin accumulating raw liquidity. The goal is to reach a 30% cash position. This money isn't just sitting idle, it sows as dry powder, waiting for the moment the crisis hits. This formula transforms a static portfolio into a pressurized system, specifically engineered to absorb a shock and then utilize it. When the geopolitical choke point snaps and oil prices spike, the broader stock market will begin its rapid descent. This chart shows the mechanical reaction inside the portfolio. Standard holdings drop into the red, while the oil hedge inversely shoots upward into the green. This is when you execute the move. You sell the highly inflated oil asset to capture a massive capital gain. By structuring this beforehand, you have converted a broad market catastrophe into a sudden, localized injection of cash. Now you enter the re-entry phase. You take those fresh oil profits and combine them with your 30% cash stockpile at the bottom of the crash. You deploy that liquidity. You aggressively buy up stocks, precious metals, and other hard assets while they are trading at a significant discount. This newly bulked portfolio perfectly catches the upward momentum of the market as government stimulus begins to drive prices higher. This is the oldest rule in finance, buying low and selling high, but it's executed through a deliberate macro hedge. This strategy turns market volatility into a structured mechanism. It allows an investor to use a crash to acquire more assets for every dollar spent, increasing long-term potential. Right now, I am managing my actual real money in a way that breaks from the standard market playbook. On one hand, we are looking at a geopolitical threat in the Middle East that could trigger a fast, vicious stock market crash and a severe recession. Yet, at the same time, our economic system is built for a great melt-up, where the logic of current policy forces financial assets and prices to continue climbing over the long term. This creates a difficult choice. How do you prepare a portfolio for a market facing a probable short-term shock on one side and a persistent inflationary mandate on the other? To protect your wealth in this environment, you have to break down the two different forces driving these colliding timelines. The long-term upward trend is driven by systemic political overspending. Decades of ignoring the budget have resulted in a federal debt crisis, where the government has borrowed more money than it can ever realistically pay back. That leaves politicians with two paths. Option A is a default. Simply telling lenders that the money is gone would likely freeze global credit markets and trigger a systemic collapse. Instead, they choose option B. The Federal Reserve prints trillions of brand new dollars to pay back lenders and keep the system functioning. Choosing this path sacrifices the purchasing power of the dollar to avoid the immediate disaster of a default. When you pump trillions of new dollars into the economy, you create an everything bubble. The actual value of these assets isn't necessarily increasing, but the nominal prices attached to them are. We see it at the grocery store. This pack of bacon doesn't contain more food or better ingredients than it did 5 years ago, but it now costs $6.99. You're simply paying more dollars for the same item. The persistent rise in prices is the logical outcome of a government choosing to inflate the currency rather than face the consequences of its own debt. This process is known as monetizing the debt, and it works exactly like a standard home mortgage. Imagine you make $100,000 a year and take out a $300,000 mortgage to buy a home. If extreme inflation hits, your salary and house price multiply by 10. Suddenly, you're earning $1 million, but your $300,000 mortgage remains static. With your inflated income, paying off that old debt becomes effortless. The US government uses this same mathematical trick on a federal scale, using devalued dollars to more easily wash away the trillions it borrowed in the past. Recognizing this mechanism shows why staying invested is mandatory. It is the only way for a regular person to ride the same wave of inflation that the government is using to manage its debt. While that covers the long-term outlook, a geopolitical wildcard could jam the gears: the Strait of Hormuz. A disruption in this specific energy choke point could trigger a sudden energy crisis. A shock of that magnitude would temporarily overpower the effects of money printing and throw the economy into a recession. The structural force of devaluation continues to push prices up in the background, even while these geopolitical wildcards threaten a violent market crash in the foreground. This forces you to confront the final investor's dilemma: how to navigate the gap between a looming energy shock and the coming inflation wave. If you pull all your money out to hide from a crash, your raw cash will be slowly eaten away by long-term devaluation. But if you stay fully invested right now, your portfolio is exposed to a potential wipeout when the short-term recession hits. A defensive strategy requires playing both timelines. First, you keep a foundation in hard assets, tangible wealth that will naturally rise as the currency loses its value. At the same time, you must keep a specific amount of liquidity entirely on the sidelines. When a geopolitical shock occurs, the resulting panic causes the prices of even the most valuable assets to temporarily drop. That is the moment you deploy your sidelined cash, acquiring those assets at a deep discount while others are selling in a panic. Effective financial defense focuses on positioning yourself to buy during that dip, securing assets at an artificial discount before the government's inevitable return